but they like the cyclical trade. Do you? Should we still be focusing on this reopening story, Larry?
So I think we have to discriminate when we talk about that. First of all, we do like the cyclical trade. I do like technology. I do like industrials, communication services, and financials. But I think when people are talking about the reopening trade, they're talking about more specific things like hotels and airlines and restaurants. And I think those are the areas that I'm more cautious on. And the reason for that is that when I look at earnings, particularly when I look into next year, those industries that we're talking about reopening, they actually have seen their earnings go down about 40% since the pandemic began. But if you compare that to places like, for example, technology, they've actually been revised up 20%. So I'd rather be where the earnings growth continues to be revised higher and there's plenty of visibility in the future.
How much of a headwind, though, as you mentioned, big tech crushing it, as we've seen all week, are higher yields? I mean, is that going to be an issue for these stocks going forward?
See, I think there's a lot of false narratives in the market, and I honestly believe that that's one of them. If you look at higher rates, we've gone back and looked at the last 12 times that interest rates have moved higher, and the market's actually gone higher as well in 10 out of the 12 times, and the 2 times where it's been down, it's only been down a bit. And the reason that happens is because when you have higher rates, that's usually accompanied by better economic growth, and better economic growth gets you better earnings growth. And tech has usually been one of the places that has shined in that type of an environment. So I'm not necessarily afraid of a modest rise in rates from here.
What about what's been said on the tax front this week, Larry? How much do you think that is going to in any way hold back economic growth or hold back risk-taking from your investors? Or again, is that something that in history it shows actually doesn't matter?
Yeah, I mean, if you go back in history, that's another one of those false narratives. As an example, if you look in the post-World War II era, there have been 4 times where corporate tax rates have been increased. And in each of those time periods, the S&P 500 has rallied 6 months before and 6 months after those higher tax rates have been implemented. Again, the reason the market's been able to digest those higher taxes is because the economy was strong. So as long as this economy remains strong, I think that the equity markets can continue to go higher. Now, that being said, I think there's a demarcation line. I'm comfortable, and I think most people are assuming that that corporate tax rate will be around 25%. If it goes above that, then I think I'd be a little bit more cautious in it because I do think you'd see a little bit more volatility, at least in the near term.